How the meeting will start today is Neel's going to mention some of his opening remarks, and then we're going to open up the microphone. There is a microphone runner, so please raise your hand when you have one of those tough questions for Neel, and the microphone runner will come to you. So that's how we will run that today. And again, I really appreciate everyone coming, and please take advantage of this rare opportunity to visit with Neel directly. To introduce Neel Kashkari is a very tough task. He has a very vast, diverse, and impressive background. Today, I'm just going to hit the high points that I think are the most meaningful or the most interesting, at least to me. Neel started out his great career as an aerospace engineer, developing technology for NASA. He also worked in investment banking. He worked for the U.S. Treasury. And in 2008, he became the Assistant Secretary of the U.S. Treasury. And as many of you will remember, those were very tough times in our U.S. economy, to say the least. And in fact, Neel headed up the TARP, the Troubled Asset Relief Program for the United States, and it's in large part credited to getting us through the financial crisis with really minimal damage to our system and our economy. And so Neel headed that up. And then somewhere in all of that busy schedule, he also found time to run for the governor of the great state of California. So you can tell he's been a very busy man throughout his life. And I guess with that brief introduction, Neel, welcome to Billings and welcome to southeastern Montana.
Thank you very much, Bill. Thank you. Thank you, Bill, for hosting, for moderating. Thank you, Chancellor, for hosting us. And thank you all for being here. And to our current and former board members, really appreciate it. As Bill said, I really want to make this an active discussion. I'm not here to give a speech. I'm really here to learn and listen and answer questions. Let me just start just to level set on why I'm here. So the Federal Reserve is our nation's central bank. We were created by the United States Congress in 1913. And Congress wanted to make sure that all the different regions of our country were involved in the nation's economic policy making. So one of the main jobs of the Federal Reserve that you may read about in the news is we set interest rates for the nation. If the economy looks like it's overheating, the Federal Reserve will typically raise interest rates to try to cool it off. If the economy looks like it's slowing down, the Federal Reserve will typically cut interest rates to try to give it a boost. Well, Congress created this really interesting structure where they created 12 independent Federal Reserve banks, 12 Federal Reserve districts, so that all the different regions had a voice in that process. So the Minneapolis Fed is the 9th Federal Reserve Bank, and our district represents Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. So our jobs are literally to represent you. So a big part of my job and my colleagues is to travel around the region to understand what's happening in the local economy, bring this information back to Washington, D.C. I go back to D.C. every 6 weeks for what are called FOMC meetings, Federal Open Market Committee. And part of what I'm doing in those 2-day meetings is speaking about what's happening here in the local economy. So me having a town hall like this is really about me learning from you. So as you ask questions and offer comments, I'm really interested in hearing from you what's happening in your economy. What's happening in the job market? Are people able to find jobs? We're in a college campus. Are the students who are graduating from here able to find jobs? What's happening to wages? Are businesses hiring? Are they investing? I'll give you just a 30-second snapshot on what we're seeing in the national economy. And then when we go into Q&A, you can tell me if this resonates with what you're experiencing here. The national economy right now, the outlook is mixed. On one hand, the job market continues to be strong. You know, over the last 10 years, the U.S. economy has created millions of jobs, and a lot of people have found work, and that's really good news. We're seeing wages slowly start to pick up. They're not rocketing, but they're slowly starting to pick up. So workers generally are doing a little bit better. And we're seeing the highest wage growth on the low end of the income spectrum. And that's great news. They're long overdue for a raise. 70% of the U.S. economy, roughly, is consumption. It's you and me and our families spending money on the things we need every day. So if people have jobs and wages are slowly picking up, generally speaking, on average, families are doing a little bit better, and they're spending that money on their families. So that's driving economic growth. That's all good news. On the more cautious side, businesses seem to be pulling back. Business investment has been slowing down in the last 6 months or so. We hear anecdotally that businesses are nervous about the outlook, so they're not investing quite as much. So that can be a little bit of an ominous signal for the future. If businesses don't invest today, they're not going to produce as much in the future. And we're seeing some signs that businesses are slowing their hiring. So that's a cautious signal. And then if you look at the global economy, Europe appears to be slowing, China appears to be slowing. Some of that may be related to the trade wars that are going on right now. And we hear from businesses that they're nervous, US businesses that export abroad, they're nervous about the trade war and how long it's going to last and what that means for their own future markets that they want to get access to. And then last comment, then I'll turn it over to Bill. Closer to home, the ag sector in America has been suffering for a number of years. It started out with just a lot of production leading to low prices. That has continued. Add to that, some of their end markets have been disrupted because of the trade wars. So I hear from a lot of farmers that they are anxious. Some smaller farmers are selling out to bigger farmers, more consolidation in the ag sector. So the ag sector has been under strain for a number of years. Here in Billings, one of the things that I've learned is that you generally have a pretty diverse economy. You're not beholden to any one sector. So while ag is suffering, other sectors seem to be doing well. So the Billings economy appears to be a little bit more resilient so that it's not impacted by one sector or two sectors. So that's kind of good news for Billings overall. But that's kind of a high-level overview. Would love to hear from you what's on your mind. How's your outlook for the future? I'd love to hear from students how you're thinking about your job prospects, where you want to go to work. And then I'm obviously really here to answer questions as well about the economy or about the Federal Reserve as well. So thank you. We got a great turnout. I know they roped off the back rows. Apparently people from Montana don't obey the rules. You all just hopped over the ropes, which is great. Everybody's got a seat. So that's good. Thank you. And Bill, turn it over to you.
We definitely know how to handle ropes in Eastern Montana. Maybe before we get started, would you talk a little bit about the dual mandate
Sure.
that the Fed has and how that works and how that really drives all of your decisions at the Fed?
Yeah. So speaking about monetary policy, Congress has assigned to the Federal Reserve two predominant goals. One of those goals is stable prices. Basically, an economy that's not overheating, an economy that's not limping along. Steady. Think about steady growth. And then the other goal is maximum employment. As many Americans as possible in the job market having a job gainfully employed. Now, we typically think that these two goals are linked like a seesaw. If the economy heats up, what the Federal Reserve will do is, as the economy heats up, businesses have to compete with each other to find workers. So then they bid up, wages go up, and then that can lead to a tighter job market, so low unemployment, but that can lead to higher prices and higher inflation. So as the job market heats up, you think that that could lead to inflation. Or if the economy is limping along, you think there's a recession, the unemployment rate goes up and the economy slows down. So we're trying to balance this seesaw. Well, what we do is, if it looks like the economy is heating up and overheating, the Federal Reserve will raise interest rates to try to cool it down. How does that work? That means it's more expensive for you to take out a loan, either to buy a house or to buy a car, or for a business to take out a loan to go build a new plant or manufacturing plant. So we can raise interest rates to cool down that activity, which will slow down the economy and it'll soften up the job market. Or we can cut interest rates to try to provide more of a boost to investment, a boost to consumption, to tighten up the job market. The Federal Reserve has been raising interest rates most of the past 3 or 4 years because we thought the job market was getting tighter. I'll say, this is public information, I was generally opposed to those interest rate increases because I did not see evidence that the U.S. economy was overheating. I did not see evidence that the U.S. economy, that we had reached maximum employment and wages were about to take off. So I objected to those interest rate increases. Nonetheless, it's a committee. The committee votes. I didn't win, so we went ahead and raised interest rates. Since that time, in the last 6 months, the committee has shifted and we've now started cutting interest rates. We cut interest rates twice, last week at a meeting, and then earlier in the summer we cut interest rates. I supported those cuts. In fact, I argued for steeper interest rate cuts just because I see no evidence that the U.S. economy is running at capacity or beyond capacity, there's no reason that we should have interest rates trying to hold the economy back. So anyway, that's kind of a long answer to our dual mandate, but that's the bread and butter of what we're trying to do every day.
Thank you. Remember, raise your hand if you have a question. The mic will come to you.
We got a question up here in the front. And just in full disclosure, this is being live streamed, so people all over the world are going to hear your question. No pressure.
Yeah, no pressure at all.
But please introduce yourself, just so if you ask a really good question, you're going to get credit for it.
Hi, I'm Haley Blackwell, a recent MSU Bozeman graduate, working at the bank there as a credit analyst. And my question has to do with the high money market rates right now. I was reading an article that said the liquidity coverage ratio adapted after the '08 crisis is the main reason for that. And I was wondering your thoughts on that, and if you think any other regulations that came after the '08 crisis will cause problems like this in the future.
Well, thank you for your question. You're starting out with a very technical, impressive question. So something happened in the last couple weeks where there are these short-term money markets where banks and investment firms trade funds with each other. And typically they're not very exciting. They're very low interest rates. They closely follow the interest rate that the Federal Reserve sets. So we move a short-term rate up and down, then these other money markets move up and down in lockstep with us. Well, in the last week or two, the spreads widened quite dramatically. So some of these other markets, the interest rates went up much higher than we would have expected. And people have asked, why has that happened? There have been new rules put in place that force banks to have more funding and have more reserves that they have to maintain. That is probably part of it. But I think the bottom line is, I don't see this as a big problem. I mean, I think that banks need to plan for their own liquidity needs, and if they had to pay slightly higher interest rates or higher interest rates to meet their own liquidity needs, so be it. Banks can always come to the Federal Reserve. We have something called the discount window, where banks can come to the Federal Reserve if they need a loan. They can pledge collateral to us. We can give them an overnight loan. That's always available there. If they chose to go to the market and pay higher interest rates instead of coming to the discount window, that's their issue. So I think that the new rules put in place, we are all learning exactly what the implications are, but the rules put in place are designed to make the banks safer so that they don't have to turn to taxpayers if they run into trouble in the future. Those are good rules, and I think we're all learning exactly what the implications are. So it's not something that I think we need to overreact to. I think we're learning. So thanks for your question. Thanks for going first. I appreciate it. Other questions? The microphone's coming to you, sir.
Right behind you.
Okay.
Why didn't the bond rating agencies, Standard & Poor's and Moody's, say something when Lehman Brothers and others were doing bundling of AAA good loans with crumb loans in 2008 and before, causing a meltdown?
So just a little more background. Maybe everyone understood it, but just a little more background. The rating agencies, so the banks back in the day, before the crisis, would take all these loans, all these mortgage loans, subprime loans, and bundle them together, and they'd make these things called mortgage-backed securities. And then the rating agencies would come along and evaluate those, are these good or not? And they assigned a tremendous amount of those with the AAA rating so that insurance companies and other investors bought them. Now we know that many of those mortgage-backed securities were junk, they were garbage, yet they got the AAA rating. I think people have looked at the incentives where banks would be able to shop their deal to different rating agencies and say, hey, we're only going to pay. So banks would pay the rating agency to assign a rating to it. So the incentives were perverse. They were basically buying ratings, and they could play them off each other and say, hey, if you don't give me a AAA rating, I'm going to go to your competitor, pay them, and then they're going to give me a AAA rating. The problem is that system seems to still be in place. You've still got the rating agencies out there. And allegedly we've learned our lesson from '08, but history has a way of repeating itself. We all have a way of forgetting these lessons. So I think there's a pretty good chance that we're going to repeat some of these mistakes again. Unfortunately, the rating agencies seem to be woven into the fabric of our financial system, and it would have been great if we could have developed a system that didn't have this in there, and we haven't yet. So you're right to raise it as a historical concern. I think it's still a concern today. But we've started off with two very meaty, heavy questions. I don't want that to discourage everybody else from asking more basic questions. So please, there are no dumb questions.
Okay, I'll start off with a dumb question.
So before you give us a dumb question, please tell us your name so we know who asked the dumb question.
So I'm recorded. Dean McSweeney, and I'm a retired banker, so that tells you I'm dumb. So just curious, you know, it was my understanding that the Fed had some responsibility of monitoring money supply, and I'm just curious with the growth in this cryptocurrency area that seems to be somewhat unregulated. What are your thoughts about that growth of cryptocurrency and influencing the overall money supply, the traditional money supply instruments?
I don't have any concern about crypto competing with the dollar. Here's the thing. The reason that government currencies, the dollar or the euro or the yen or the pound, part of the reason that they have value is because only the government is authorized to produce them. If you went and started printing dollars in your basement, the Secret Service would come and arrest you. So we have a monopoly, the government has a monopoly on creating dollars. Well, cryptocurrency is like the Wild Wild West. I can go tomorrow and create Neel coin. You have Bitcoin, you've got thousands of these coins that have been created. They're basically garbage coins because there's no barrier to entry preventing you or me from creating our own flavor of ice cream. Get a Bill coin and Neel coin and Billings coin. And so there's just all this garbage that's out there today, and there's no way to keep more garbage from being introduced. So the big concern, it's not that it's going to be a competitor to the dollar. I'm not concerned about that. The bigger concern is that people have been fleeced out of tens of billions of dollars because they've been told, boy, this is the next Bitcoin. This is the next sexy thing. Give us your real dollars and we're going to give you some garbage coins. And a lot of people have been fleeced. And so now the SEC has weighed in and said, hey, these are securities that should be governed, regulated like securities offerings. And if you're going to have a securities offerings, you got to follow the rules and you're going to have appropriate disclosures. So I'm glad the SEC is doing this. I wish they had done it years ago. It would have saved people from getting fleeced out of billions and billions of dollars.
Hi, my name's John Hedge.
Hi.
With something like $17 trillion of negative interest rates around the world, could you help me with is there a possibility of a 1-minute explanation of why that occurs? And number two, could you ever contrive a sequence of events that we could ever go negative interest rates here?
Sure. I'll try in the 1 minute just to lay the framework. So there's a concept that we wrestle with every day at the Fed of what is the neutral interest rate. What interest rate neither stimulates nor restrains the economy? And think about it as a neutral real interest rate, net of inflation. But anyway, just say neutral interest rate. Well, we don't set the neutral rate. The neutral rate is set by broader economic forces like demographics, like productivity development. So we think over the last 40 years, neutral rates all around the world have gradually been falling. So let's think about a line like this. The interest rate has fallen over 40 years. That defines neutral. So what central banks are doing is we're moving the interest rate that we control up and down around neutral to stimulate or slow down the economy. But we don't set neutral. So why is this happening all around the world where interest rates, so they're not negative in America, but they're very low relative to history. They're negative in Europe, they're negative in Japan. What we think is going on is that the advanced economy societies are all aging. And the aging society leads to different spending and investment and savings decisions. And former Fed Chairman Bernanke has talked about it as a savings glut. We're saving a lot more in advanced economies, and we're investing less. So part of it is society is aging, so we have more savings. Part of it is there's less demand for capital for investment. And if you have a lot more savings and less demand for that savings, you lead to lower interest rates, maybe even negative interest rates. So where are the big demand for capital in America? The biggest demand for investment capital in America over the last decade has been in the oil fields, in fracking, in North Dakota, here, in Texas, in Oklahoma. Massive amounts of capital have flown in to fund that development in very profitable business. Where else is there? You think about some of the big innovations in America in the last decade. Think about Twitter or Facebook or Instagram. They're neat little toys, but they don't take much capital. So where are the next big demands for capital? And so I look at it as a lot more savings, less demand for capital, you end up with a low neutral interest rate, which then leads to lower negative rates in some cases. Could I envision a series of events that would lead us to have negative interest rates? I could. It's not my base case, it's not even my second or third case. But the fact is that it's so pervasive around the world. A lot of people, especially in the financial Twitter sphere, say, oh, this is all central banks doing. They're giving us way too much credit. Central banks are responding to these broader economic forces that are driving interest rates so low, rather than being the ones that are actually in control, leading to interest rates being this low. He has a follow-up question. Maybe you can shout it and I'll repeat it.
Is infrastructure, private, public, a big enough ticket that would be that demand?
So is infrastructure a big enough ticket that could be that big demand for capital? It could be. I think it could be. The question is, what are those infrastructure investments to be made? And then it gets into the political system. How do you reach political consensus on what we should be investing in? One thing I think we should invest in, this is just Neel as a private citizen, not speaking on behalf of the Federal Reserve. A lot of my district is rural, and a lot of districts, a lot of the region don't have access to broadband, right? That to me is, I think we as a country should just write the check and go wire up rural America so everybody has access to broadband. We could easily afford it. The challenge is there political consensus to do it? But I think that's a no-brainer. Is that enough? It's probably not big enough to move the needle to actually change where interest rates are.
And sir, number one, it used to be the dream of every person to own their own home. That was the American dream. Do you think that's still true?
Well, I don't know if it's still true that every person wants to own their own home. I think a lot of people do. I don't know that everybody needs to own their own home. I've rented it many times in my life. My wife and I own a home now. I think people need to decide for themselves.
The second question, you may have, I'm sorry?
Go ahead.
The second question, you may have answered this with the Bitcoin question. A quick elevator speech about what is blockchain technology and where do you think the future is?
Well, so what is blockchain? And so cryptocurrencies and blockchain are related, but not the same thing. So blockchain, basically, if you have a bank account, so Bill's bank, every one of Bill's customers has an account at the bank. There's a ledger with, if I were his customer, there'd be a Neel Kashkari line item, there'd be an account number, and then there'd be a dollar value. And whenever I transact, it goes in and out of his ledger. So blockchain is meant to be this thing where Bill doesn't hold a ledger. There's one global ledger that's maintained by computers all around the world that we can all see. So that way, the allegation or the assertion is that is somehow safer than me counting on Bill's accounting system not getting hacked. Maybe it's safer, maybe it's not. So far, the early feedback on Bitcoin and these alternative currencies, I've never met anybody who's actually bought a physical good with one of these things. I go to college campuses, they love asking me about Bitcoin, and I say, great, have any of you bought anything with this? I've never met anybody who's bought anything with Bitcoin. So it doesn't strike me as a particularly useful thing other than a speculative device, like you're just speculating that the price is going to go up. And then blockchain looked like it had a lot of early promise, like maybe there's some use for this thing. There have been a lot of pilot projects on Wall Street and otherwise. I have yet to find out some actual substantive use for this blockchain technology. It definitely is a technology looking for a use rather than a problem where a solution is being developed for it. Who knows, 10 years from now, will somebody find some use for it? It's conceivable, but so far, I'm unaware of any actual use for blockchain, other than as a marketing ploy. Who's got the mic? Hi. And then we got a gentleman in the front has a question next. Sir, go ahead.
Okay, can you hear me? Neel, this is kind of a follow-up to John's question over here. My name is John Vondra. And what that low interest rates imply to me is maybe in Europe and Japan, maybe there's a lack of demand for growth of economy. Maybe would the word stagflation be an appropriate term to use or to describe what they're incurring overseas to create that situation in which we have zero or negative interest rates? And I understand why they're buying all the treasuries because we have the highest rate in the world, but could that eventually come to roost in America?
Sure. I mean, I do think So Japan's economy is interesting. Their economy on a per capita basis is actually growing pretty well, or per worker basis. They're actually growing as well as America is. Their aggregate economy is not growing very fast, in part because their population is declining. So population growth is actually a really key factor here in economic growth and having a vibrant capitalist system. What do we do if the population is not growing? I think that's a tough thing. Monetary policy really cannot solve what is fundamentally a demographic issue. So I don't think stagflation is the right word, because I think it's much more demographic driven than an oil shock driving up prices where the economy has to shrink to the new equilibrium. What was the second part of your question? Just say it out loud.
Oh, could that come to roost in America?
So, because they're buying our bonds now. May that not? Right now, the U.S. economy is by far the strongest major economy in the world. And investors around the world have more confidence in the U.S. economy than any other economy in the world. And yes, I know every time we turn on the news, it seems like we've got great political anxiety in our country and lots of dysfunction. I still wouldn't trade places with any other country in the world, right? Europe has its own big problems. China has its own even bigger problems. Our problems, I think we can address them. So eventually, we do know that we have to be able to live within our means. We cannot keep increasing our debt levels forever. Eventually, the bill comes due. The question is, how long do we have? And nobody knows. Because right now, it's a relative game. So while we have fiscal challenges, we have political challenges, we're still better off than other major economies. And so investors are saying we'd rather invest in America than in Europe. Now, maybe Europe gets its house in order. Maybe Europe becomes a better, more attractive place to invest. Then all of a sudden, our runway shortens. And then all of a sudden, investors might make choices. Now, it's hard to imagine Europe's going to get its house in order before we do, but they could. Or maybe China develops its bond market and its capital markets, and China becomes a better place to invest. And then investors, because investors have choices. So we know we cannot expand our debt forever. I don't know how much time we have, because right now we're benefiting from the fact that we're stronger than other countries. Long answer to your question, but a complicated question.
Hello, my name is Sean Reelbert. I'm Chairman of the State Tribal Economic Development Commission. And would like to state that in years past, the Federal Reserve Bank has worked with 8 tribes in the state of Montana to develop their legal infrastructure. And the Federal Reserve Bank also partnered up with the National Commission on Uniform State Laws to develop our Uniform Commercial Code, which is called the Model Secured Transactions Act. With that, we now can perfect a lien. In addition to that, we can register our tribal businesses and our individual businesses. Not only that, that also increases economic development on the Indian reservations in the state of Montana. With that, the question I would like to ask is, how can we repartner and reestablish our legal infrastructure and increase our economic development so that we have the legal infrastructure, financial legal infrastructure, so that the tribes, the enrolled membership, and their businesses can thrive. So if the Indian tribes in the state of Montana are thriving, then the state of Montana thrives. So based on that, we need to reestablish that partnership. With that, what can you tell me, and what kind of steps can we take to move in that direction with that legal infrastructure development?
Thank you. Thanks for your question. I really appreciate your question. We'd love to continue to partner with you. We have at the Minneapolis Fed, I want to talk about 2 things. One is we have a Center for Indian Country Development, where we have dedicated professionals that are focused on trying to bring economic development to tribes in our region, in Montana, and in around the country. They've recently been doing a lot of work on housing and helping navigate the very complex legal issues with folks buying a home on a reservation, how they can get a mortgage, et cetera. So there's a whole focused effort on that. And in Montana, in our Helena branch, we have folks who are also focused on these issues. We have Casey Lozar is somewhere here in the room. Where's Casey? Way in the back. Casey's there. He's our Helena branch leader, and he's also helps work on some of these issues. He's done work for the state of Montana on tribal issues as well. So I want to make sure that Casey and you connect at the end of this, because he'll come find you and make sure that you guys are connected, because we care about this issue. We still do. We are still doing work in this, and we want to be partners with you and your peers to have as big a positive impact as we can. So thank you for raising it. Others, questions?
Hello, Neil. Welcome to Montana.
Where are you?
I'm back here.
Hi there.
I've got old knees, so standing up makes me feel better anyways.
Good.
My name's Al Ekblad. I'm head of the Montana AFL-CIO. And so I'd like to go and talk about full employment. First, you asked for comments about the economy. Since 2008, after about 2012, our members in the private sector did fairly well. We've seen significant recovery, but we are seeing that tighten up drastically in, say, the last 18 months of negotiations. There is concern about raising wages, and there is now a renewed effort to take back benefits in the form of more co-pays on health insurance and reducing contributions to retirement. Our public sector workers in Montana have not made significant recovery. They've had incremental, very small raises over the last 10 years, but quite honestly, they're struggling. My question related to employment is, how does the Fed define full employment? What is employment? And do you do any work to differentiate between what is a career-driven job versus what may either be entry level, but now is actually turning into a substandard job that does not support an individual or a family and requires significant public subsidy for a family or an individual to survive. So in that realm of employment, what work are you guys doing to look at what is quality employment? And to finish that up, is there a role for the Fed? Can you help increase quality employment from your position in the economy or not? Thank you.
Yeah, so there's a lot there. Let me start by answering your question on what does full employment, or we call it maximum employment, mean. I'm going to tell you what it means to me. I talked about that we've got these two goals. Stable prices, which we define as 2% inflation, and if you want to talk about it, I can explain why, but just humor me for a moment. We define stable prices as 2% inflation and maximum employment. Maximum employment, in my mind, if we go beyond it, we end up with inflation above 2%. So maximum employment, in my mind, is everybody's working such that we end up with an economy that's running at steady state at 2% inflation. And if you try to push the economy, it's like pushing your car beyond the red line. Eventually, it breaks the engine. So that's kind of the red line. Maximum employment equals 2% inflation. So to me, there are bridges that we have to look at. So one is the unemployment rate. The unemployment rate today is around 3.7% nationally, but that only includes people who are actively looking for work. That number is calculated because the government agents call up people, they do a phone survey, and they get you on the phone, and they say, are you looking for work? And there are a lot of people who say, no, I'm not in the job market, I don't have a job, I'm not looking. Well, the darndest thing happens over the last several years. A whole bunch of people who 1 month say, I'm not looking for work, the next month when they answer the survey, they have a job. Well, how does that happen? They weren't looking for work, and then they went and they got a job. Well, it turns out there are a bunch of people out there who are not counted as unemployed, who are, whether they know it or not, actually in the job market. And as the job market has gotten stronger, this shadow labor force has re-entered. And so we've seen the unemployment rate fall from 10% to 3.7% nationally, but wage growth has only picked up a little bit, modestly. If we were really at maximum employment, we should see faster wage growth because businesses should be having to compete with each other to find workers and to keep workers, and that should lead to faster wage growth. Wages have come up, but they've not come up to levels that would imply to me that we're really at maximum employment. So there's one bridge between the job market and wage growth, and so wage growth has come up a little bit. There's another bridge between wage growth and actual inflation. So in my mind, we're a long way away from the labor market actually leading to inflation above 2%. So that's why I don't think we're at maximum employment. I mean, just in your question, you said that the private unions have seen faster wage growth than the public unions. Is that right? Yes. Well, how is it that the public sector has been able to get away with paying less? Right? I would think that if there's all this great demand for workers in the private sector, the public workers who build buildings for the public sector would just say, I'm not going to do that work anymore. I'm going to go work for the private sector unions. And then the government's going to have to pay more. So until we really see this real pricing pressure across the economy, it tells me we're not really at maximum employment. And the best way to judge that is by looking at what's happening to wage growth. And until we see wages pick up, I don't think we're really there. To your question about what the Federal Reserve can do, there's two things. One thing is, at the Minneapolis Fed a couple years ago, we launched this new research center called the Opportunity and Inclusive Growth Institute, where we're trying to use our research experts, our PhD economists, to analyze why are these very different experiences in the labor market? What leads to these very different outcomes, and what are policies that could lead to better outcomes for folks? Many of those policies we can't control, but if we can analyze it, then we can make a contribution by shining a light on it, and others can take it forward. And then what I'm also learning, as the job market has gotten warmer, we've seen tremendous benefits across the labor market, right? Today, because businesses say it's harder for them to find workers, they are giving ex-cons a chance that they wouldn't have given a chance 2 or 3 years ago. They are saying for certain jobs, we're not going to do the drug test because we don't need to. Why are we needlessly excluding people from certain jobs? Or they used to say, you know what, I have this CNC machine, and I used to just put up a help wanted sign, and I'd get 10 CNC operators saying, I want to take that job. Then they couldn't find them anymore. So now what they're doing is they're saying, we'll train you to use that machine. These are all great developments that are happening because businesses have to do it to get the workforce that they want. Now, it's not the Fed telling them to do it, but if we can keep the economy growing and keep the labor market strong, businesses are now having to go the extra mile to try to train and develop the workforce that they want. So I actually think that is a role the Fed is playing behind the scenes in trying to keep the job market strong. And we're seeing, as I said earlier, we're seeing the strongest wage growth now at low-end workers. That's great news. They need the raise. And that's why I'm trying so hard to keep the economy running, keep the job market strong, so that workers get the benefits. Very long answer to your question, I apologize, but there was a lot there. And Bill, feel free to chime in here at any time if you got questions or comments or you want to disagree.
I told you I like the easy questions.
All right.
I'm Ron O'Donnell, and Neil, you talked about the Fed lowering interest rates over the last few months. Last week, the intervention in the repo market. At what point do you think the Federal Reserve looks at quantitative easing for?
So the Fed's traditional policy tool is moving this short-term interest rate up and down. It's actually an overnight interest rate between banks. You and I don't actually care about overnight interest rates. If you take out a loan to buy a car or to buy a house, you care about interest rates for the next 5 or 10 years. Well, the way we think monetary policy works is we move overnight interest rates up and down. That actually has some effect on long-term interest rates because people think interest rates will be lower in the future if we cut short-term interest rates now. Well, once we reduce interest rates to zero in the crisis, the question was, is the Fed out of ammunition? That's when the Fed turned to quantitative easing, buying up long-term bonds to try to drive long-term interest rates down. And I supported that. I think it actually had some benefit. My gut would be we would probably not turn to quantitative easing until the economy slowed such that we moved the short-term interest rates to zero first. I think the first thing we would likely do is move short-term interest rates to zero before we would turn to quantitative easing to start expanding the balance sheet to provide more stimulus at the long end of the yield curve, would be my guess.
Hi, Laura McGee.
Hi, Laura.
I, for the last quarter, have been asking my financial advisor for advice of moving money from my brokerage account into index funds. And I feel like what I hear from her is be cautious, because she said we're on a 10-year high and that should correct, and they expect that correction to happen at some point, and have been reading articles. And so as an investor, I'm hearing be cautious now, and have been cautious of moving from my brokerage account into my index fund. And just your thought on that, if that, somebody asked about the mortgage, the 2008 crisis. I did read an article that was linking maybe what was happening then is brewing now.
Well, I think there's a couple parts to your question, at least in my mind. One is I'm not in a position to give investment advice. I'm not supposed to, and I wouldn't be confident to give you investment advice. But I'll say, let me talk about the economic risks, and you can judge for yourself. We're always trying to forecast recessions. Recessions are very, very hard to forecast. If we could forecast a recession reliably, we would then take action to prevent it. So then we would try to, so then you may be less likely to have a recession. The single best indicator of a recession is this thing where the yield curve inverts, where if the U.S. government borrows money from all of us. If you buy a treasury bond, you are making a loan to the U.S. government. If you buy a 1-year bond, you're making a 1-year loan to the government. If you buy a 10-year bond, you're making a 10-year loan or a 30-year loan. Well, typically, if you lock up your money for longer, you want a higher interest rate. So the yield curve generally slopes up. Longer-term bonds have a higher interest rate. Well, once in a while, it inverts, where longer-term bonds have a shorter interest rate, lower interest rate than short-term bonds. And every time that's happened in the last 50 years, a recession has followed. Well, that has roughly happened now. There are lots of excuses for why. Some people try to say this time is different, but they always say this time is different, and then a recession ends up following. So this is a concerning signal. I'm not forecasting a recession. That's not my base case scenario. But the warning lights are now flashing that a lot of investors are nervous about the economic future. But what does that mean for the stock market? I don't know. Does that mean it's a good time to invest? I don't know. It means that the recession risks are higher now. The other question that I feel a little more confident in answering for you is a lot of times people want to go to index funds because they are cheaper. Let's say you want 50% of your assets in equities. I'm not saying that's right or not. Let's just say you decided that. Generally speaking, a cheaper way to get 50% of your assets in equities is to invest that 50% in index funds. That is probably cheaper than investing that 50% through a brokerage account, which probably has higher fees. So I'm not going to tell you what your allocation to equities should be. Whatever you decide is your allocation to equities, index funds might be a cheaper way of getting that allocation than the brokerage account. Does that make sense? Okay, so you need to decide for yourself what the allocation is, but then I would just encourage you to pay attention to what's a cheaper way of getting that exposure. You'll probably be better off if it's lower fees. And your broker may not like my answer.
Hello, my
Hi.
name's Don Roberts.
Hi there.
There are a number of currencies around the world that have their economy tied to the United States dollar.
Yep.
Are they being helped or hurt by what's going on right now?
Well, generally speaking, so other countries usually other countries tie their currency to the dollar because those countries' political systems have been very bad at managing their own interest rates. So the temptation is in any country, the temptation is let's just have really low interest rates because it's good for a boost to the short-term economy. It's good for politicians getting reelected, even if it's bad for the long-term health of the economy. So that's happened many times around the world. And by the way, it happened here in America in the 1970s. Interest rates were too low in the 60s and 70s, led to really high inflation. Then the Federal Reserve had to raise interest rates dramatically to get the genie back in the bottle. Since that time, Republicans and Democrats have generally said, hands off the Fed, manage interest rates for the good of the economy, not for the good of the politics. But other countries have not been able to get that political consensus. So some countries have said, you know what, we're just going to peg to the dollar so that we'll let you set monetary policy for us. So it's good in some ways. It means that if we have low inflation, they generally have low inflation. But it's bad in some ways because they don't have the independent lever of adjusting interest rates what's right for their economy. So it might be that their economy is higher growth and they need more money supplied to fuel that higher growth, and higher interest rates are appropriate, but they end up just importing the US's monetary policy because they're pegged to the dollar. So it ties their hands, which is good, so maybe it stops them from punching themselves in the face, but it's bad if they actually need to use their arms. Way in the back?
Hey, my name's Ethan Canning. I work with NAI Business Properties. We do commercial real estate statewide. My question's real estate related. We were in Vegas last week for a global conference, and there was some research put out on cap rates since 1986, so it's roughly 30 years, On the real estate side, outside of strip malls and bigger, big box mall centers, cap rates continue to plummet. I think the national blended average right now is 5.7%, with the industrial sector and manufactured housing kind of leading the charge in the mid-4s. Looking back 30 years, we've never seen cap rates that low. The cap rates now are even lower than '08. So that plus the inverted yield curve caused kind of a moderate level of concern in Vegas. Perhaps everyone was just hungover, but maybe they were also concerned. So my question is, what's your opinion from a 7 to 10 year real estate cycle like we see? It feels like we're in year 12. What's your opinion over the next 1 to 3 years on the health of the real estate market?
Well, this is something we look at. We have a whole financial stability division at the Board of Governors in Washington looking at financial stability risks, and we look at the valuations that you talk about. One of the things that's very difficult to know is this behavior, some people say, oh, this is the Fed's fault. You got high prices, it's the Fed's fault in the stock market or in commercial real estate, and people are quote unquote reaching for yield. It's very hard to know, is something reaching for yield, or are assets pricing in a lower long-run interest rate environment? Right? If you took the same cash flow and you discounted it at a lower long-term interest rate, you're going to get a higher valuation. And what is one person's reaching for yield may be another person's repricing of this lower interest rate environment. And again, as I said, I don't believe central banks actually control long-run interest rates. We control short-run interest rates. Long-run interest rates over the long term are set by broader macroeconomic forces. It's the same thing in farmland. Farmers are struggling, yet farmland prices are still quite high. On a cash flow basis, does it make any sense? Well, is it reaching for yield, or is it repricing in a lower R-star environment? So from my perspective, I think the Federal Reserve needs to do what we can to meet the dual mandate goals that we talked about: stable prices and maximum employment, keep the economy going. I don't think it makes sense to raise rates to try to bring down commercial real estate prices, because inflation is already running below our 2% target. So we would slow down the entire economy to try to bottle up the commercial real estate market. I would rather use our supervisory tools to make sure banks are not taking imprudent risks in lending, in a very concentrated manner into the commercial real estate market. And at the end of the day, if investors take losses, investors take losses. This is the market economy. Our job is not to protect investors from their own stupidity. Our job is to protect the broader economy.
Hi. Hi, Chris Forms. Would you explain modern monetary theory and how that...
I wish I could.
Well, if you can't, then no one can.
Well, so basically there's modern monetary theory is something that's getting a lot of traction in social media, and they've called it a very fancy sounding name, modern monetary theory. It's actually been around one way or another, and when people explain it, they generally mean different things. And the people who are the big zealots and advocates of modern monetary theory, basically, if you raise any questions about it, the first thing they'll say to you is, well, you don't understand it. Because they're like magic beans. It's perfect, it grows to the sky high, there's no cost, there's no risk, etc. Basically, I'll give you the thing that I think is true is that the US government has a lot more debt capacity than we realized, right? We have a lot of debt today, but if the US government wanted to go spend $1 trillion on infrastructure, they could go finance that tomorrow. And my proof is that 10-year treasury yields are like 1.6 or 1.7 today. They're still quite low. There's a lot of demand for US government debt, a lot of confidence in the US government. So I think it's true the US government has more debt capacity than maybe we realized. What I am not a believer in is that means we can go fund all of our spending dreams forever and there's no risk ultimately. Ultimately, if you spend on whether it's Medicare for all or free college or any of the different government programs that you want forever, eventually we know it has to lead to inflation. Because eventually you try to demand outstrips the production of the economy, it leads to inflation. Where is that line? I don't know. I think the modern monetary theory zealots take that too far. But I do think there's truth that the US government has more debt capacity in the near term if there's something we want to go invest in.
What's the relationship between that and monetization of debt?
Well, it gets blurry. What's the relationship between that and monetization of the debt? I mean, I think if the Fed stepped in and said, well, we're just going to buy all the US government debt and we're just going to print dollars and we're going to do this forever, that would be monetization of the debt. And that would ultimately undermine confidence in the Fed. And that would ultimately lead to inflation and inflation expectations going up. And I don't think the Fed is, and I don't know anybody at the Fed who's willing to do that.
Sorry, everyone, but we only have time for one more question. Who's the lucky last question?
Hi there.
Hi, my name is Jennifer Owen. One of the great research projects that the Minneapolis Fed has undertaken is focused on early childhood and childcare, the impact of high quality, affordable childcare to parent participation and productivity in the workforce. But of course, the ability of an adult to participate and be productive in the workforce with regards to their children goes beyond just accessing childcare. Things like poor physical and mental health among children, substance abuse in the family, all these things that we sort of categorize as toxic stress or adverse childhood experiences are thought to be a multi-million-dollar drain on the economy. And certainly in the Minneapolis Fed district, some of our incidences of that toxicity are much higher than the nation. Has the Fed thought about going beyond just childcare to look at overall childhood wellness and its impact on parent productivity and participation in the workforce?
You know, in a number of ways. We have a community development center and related to our Center for Indian Country Development where these issues come up a lot. But I think we haven't done as much work there because we have limited staff and we have to be focused on a few things. The reason the Minneapolis Fed has done such pioneering work on early childhood education is because our researchers found that the best ROI on taxpayer dollars were making sure that low-income kids got a good early start to education. And there are all these benefits to society over the long term. We don't set education policy, but we use that research to show legislators, hey, if you want to spend taxpayer money, this is what our analysis says is the best ROI. So I think we've touched on some of those issues, but have not done as much work. But I will say the reception of our work on early childhood education, at least in the state of Minnesota, has been fantastic. We've seen some interest in Montana, and we're happy to partner with folks here to try to make the case for Montanans as well.
What a great question.
Yeah, and by the way, we had a meeting on that topic on early childhood education in Montana literally this morning with business leaders in the state. So it does appear that there is some interest, which is, we're excited to partner with them on it.
Neel, I know we're short of time, but one last question.
Sure.
Since we're in one of Montana's top universities, what advice would you have for the students and the young people here today about their careers and how to get where you are today?
You know, I would say I've done a lot of things. Started as an engineer, went into banking after business school, then I went into public policy. I would just say life is long and your first job is not your last job. So, pardon me? Somebody said something. Did I imagine that somebody said something?
I think it was
oh, it was a cough. So life is long, so pursue what you're interested in. For me, there's been no grand plan. I have gone after jobs and industries and topics that I found very intellectually stimulating and challenging. And if I'm stimulated and challenged, I will probably do my best. And if I do my best, it'll probably be more likely to be successful than not. And then that'll open up doors. So there's been no plan. I'll say one last thing. You know, if you're willing to move and you're willing to try new things, you're going to have more opportunities. A lot of my peers at every step of the way. So I graduated in engineering from the University of Illinois in Urbana-Champaign. And a lot of my peers said, well, I want to get a job, but I only want to get a job in Chicago. Chicago's a great city. But if you say, I'm only going to get a job in this one geography, you are reducing your opportunities. I said, I'm going to look around the country. So I took it to the extreme. I grew up in Ohio, I studied in Illinois, I moved to California, I went to Pennsylvania for business school, I moved back to California, I went to Washington, D.C., I went back to California, and I went to Minnesota. So that's kind of taking it a little too far, but I'll say if you keep your eyes open and your opportunities open, you will have more opportunities and you'll get to do more things. So, but that's up to you. Each of us need to make our own choices on what's right for you. If you say, I'm from Billings, I only want to stay in Billings, that's great. But know that there's a trade-off. You will limit your opportunity set.
Well, thank you. And thank you for everyone to show up today.
Thank you very much. Really appreciate it.